Chapter 2.3 Analyzing Revenue, Expenses, and Withdrawal Transactions into Debit and Credit Parts. Once again, with these transactions, just like in the last lesson, we need to make sure that we answer the 4 essential questions. You're going to see these over and over. I would encourage you to have a note card and write these down until you get them memorized. This will make analyzing transactions extremely easy. Which accounts are affected? How is each account classified? How is each account classification changed? And how is each amount entered in the accounts? Well, let's take a look here. We got our kind of our 5 transactions we're going to take a look at, and we're dealing with Hal Rosen. Well, March 11th, we received cash from sales, $1,900. Before we get going, let's take a look here. Which accounts are affected? How is each account classified? How is each classification changed? And how is each amount entered in the accounts? Well, received cash from sales. Well, my first account that I'm going to look at here is going to be a cash. And cash is an asset account. Remember from the left-hand side, last lesson. Everything on the left-hand side of the accounting equation, which are assets, are going to have debit normal balances or show increases with debits and decreases with credits. From sales. So sales are going to be another one. Sales is a revenue account. It is an owner's equity account. Okay. Therefore, it's on the right-hand side of the accounting equation. To show an increase in sales, it's a revenue. It's a revenue account. To show an increase in owner's equity, it's going to have a credit normal balance, or a credit side as a increase side, and debit will be the decrease side. 99.999% of the time, you are going to be using credit entries for sales. So it's kind of a quick little trick for you. So when you see sales, you automatically know it's going to be a credit. Well, let's take a look. Received cash. How has each classification changed? Did we receive cash? Do we have more or less cash? We have more cash. It's an increase in cash, and therefore, since it's an increase in cash, therefore we are going to use the debit entry, because debit is the normal balance of cash. Because cash is an asset account, it's on the left-hand side of the accounting equation. Everything on the left-hand side of the accounting equation has a debit normal balance or shows an increase with a debit entry. Sales. Did we have more? You can only go one way with sales, and we only had one way to go, and that's a credit entry, because sales is an owner's equity account. It's a revenue account under owner equity. Therefore, we have a credit balance because it's on the right-hand side and it shows an increase. Paid cash for advertising. Well, let's take a look at this. Paid cash. So my first thing I'm going to have my cash, which is my asset account. The other account that I'm going to have is I'm going to have my advertising expense account. Now, an expense is an owner's equity account. It's actually a contra owner's equity account. It lowers the worth of the owner, but it's needed for day-to-day operations. So this one gets a little tricky here. So paid cash for advertising. Well, what we did is we paid cash for advertising. We have an expense here. An expense is an owner's equity account. It's under owner's equity. Owner's equity accounts are on the right-hand side of the accounting equation. Right-hand side of the accounting equation shows a it shows a credit as its normal balance. That means an owner's equity account shows an increase with a credit, a decrease with a debit. Expense is going to decrease owner's equity. Therefore, expenses are going to have a normal balance or an entry of a debit of $1,050. Cash, on the other hand, we paid cash. This is an easy one, so we know that cash has a normal balance of a debit. Its credit side shows a decrease in cash. We paid cash. We have a decrease in cash, so we're going to credit $1,050. Anything with an expense, 99.999% of the time, with the exception of some special situations, expenses are always 99.999% of the time going to be debit entries. A little easy. So if you think sales are credits, expenses are debits, with the exception of some adjusting entries and other different situations like that, or correcting entries, that's going to hold true. Sold services on account to Dominic Field for $18.50. Well, my two accounts, which accounts are going to be affected? Well, sold. That anytime you see the word sold or, that type of stuff, that's going to mean the word sales, and that's a revenue account. The other thing that you're going to deal with is on account. So let's take a look at this. Did we sell something to someone where we're going to get money in the future? Answer is yes. When we are going to be receiving money in the future, that is accounts receivable. So Dominic Field owes us money in the future. So that's going to be accounts receivable with Dominic Field. And then sales. And the reason we have sales is because we always record every sale at the time of the transaction. Not when they pay us cash, but at the time of the transaction is when we record the sales. So accounts receivable is an asset account. An asset account is on the left-hand side of the accounting equation. Therefore, a debit is the normal balance. It's also the entry because it shows an increase in the amount of money that he owes us. Sales are credits, therefore they're owner equity account. They give us more net worth, therefore it's a normal balance of a credit, or credit will be the entry. Like I said, 99.99% of the time, with the exception of correcting entry, sales are going to be a credit. Paid cash to owner for personal use. Well, paid cash, that should tell us one thing, that we're going to use our cash account. And then to the owner for personal use. And this is called a drawing account. The way you would think of it this way is if you go to the bank and you want to take out money, you are withdrawing that amount. So that's how you remember that it's a drawing. You withdraw money from your bank. Well, paid cash. Cash is our asset account. We are going to be decreasing our cash, so it's going to be a credit of $300. Now, drawing, owner's equity, think of it this way. It's on the right-hand side of the accounting equation. Credit means an increase in worth. Does he have more or less worth? He has less worth because he took $300 out of the account. So therefore, he's going to use a credit entry to decrease his worth. Lastly, received cash on account from Dominic Field. So Dominic Field, if you look back on the 14th of March, we sold, he owed us $18.50. Well, the future is now, and he's paying a partial amount of what he paid us. Didn't pay it all in full, but he's paying a partial amount. So we received cash on account from Dominic Field. Well, received cash, there's our first account. That's the obvious one. That's going to be cash on account from Dominic Field. So that's accounts receivable because basically the future is now and he is paying us the money that he owed us. So the money we were entitled to receive is finally coming in. So, received cash. Cash is an asset account on the left-hand side of the accounting equation. Therefore, the debit side is the normal balance, or the left-hand side is the normal balance, or the debit entry shows an increase, and we do have more cash. Now, what we need to do is we need to show that, you know what, Dominic, thank you for paying us. However, you don't owe us $18.50 anymore. You're only going to owe us $1,050. So we need to decrease the amount of money that we expect that we're going to be receiving from him because he's already paid it. So if it's an asset account, it sits on the left-hand side of the accounting equation. Therefore, the left-hand side is the normal balance side, or the debit is a normal balance. Therefore, the debit shows increase. So if debit shows increase and we need to decrease the amount of money because he paid us that he owes us, because of his payment, we're going to use a credit entry of $800. Hope this helps. See you soon.